Welcome back to Not Financial Advice. This is Sean, and today is Thursday, January 25th, 2024. The market is currently closed, and today what we're going to be doing is a review of four subscribers' stock and ETF requests, where they've asked me to take a look, peel the layers back behind some of these companies, and if possible, I'm going to try and give a fair value estimate of what I think these companies are worth. I'll ask you to like the video and subscribe to the channel. And as always, if there's a stock or an ETF you'd like for me to review, I'd be more than happy to make a video just for you. So drop that stock or ETF's ticker symbol in the comments below. And we're going to get started with a quick daily update on my portfolio and then get on to those four companies right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, guys. On no particular discerning news rather that I can notice, my portfolio has reached all-time highs, $69,200. And so let's just take a look at my top five gainers and bottom five decliners of the day. Today, the S&P 500 returned 0.53%. The Dow Jones was higher at 0.64%. Tech stocks lagged today after having a good day yesterday, up today about 0.2%. But the biggest outperformer of the day was going to be small caps. Russell 2000 index up 0.71%. And so looking at my portfolio's gains, again, $444 in unrealized gains today, 0.65%. I'm sort of sitting in between the Russell 2000 index and the S&P 500, which actually makes a lot of sense, seeing that 51% of my companies are mid or small cap companies. So today, our top performing stocks were Paramount, trading up 4.5%, Trulieve Cannabis up 3.7%, Caterpillar up 3.5%, Walgreens Boots Alliance up 3.3%, and up 3.1% was Netflix. Bottom five decliners of the day are going to be the Aerospace and Defense ETF, down 0.84, down 0.96 is Costco, down 1.08 is McDonald's, down 1.62 is Winnebago, and Tesla is down a punishing 12.1%. So that's an update on my portfolio. Overall, what I would say is working is cannabis stocks have been on a run for about 3 months. That certainly helps. And just the overall strategy and diversification seems to actually be doing well. You can see this date here. You might have noticed it before. This is how long I've been tracking the portfolio. So 60 days, I've been tracking every purchase. Let's take a look at the performance on this portfolio over a broader period of time. So I started tracking November 21. Not a huge amount of contributions, actually, you guys, during this time. But November 21st through to today, I'm up 9.4%. And again, that started on November 21st. Let's actually take a look at the S&P 500. I'm up 9.4% since November 21st. So in the last 2 months or so, I'm outperforming the index by about 1.5 points. Too short of a period of time to mean anything, but it certainly feels good and looks pretty cool as well. Okay, we're going to dive into the subscriber stock requests. Like the video, subscribe to the channel. Again, if there's one you'd like for me to take a look at, drop the ticker symbol in the comments below. First one we have as a request is the ALPS Alarian MLP ETF. So looking back to 2010, we see this ETF is down 42% from all-time highs. We can also see that since the crash, the COVID crash, this one has been moving pretty steadily up, about 168%. So I could definitely see why this might be on someone's radar. But looking back over 15 years, if I see something that's down 42% over 15 years, that's a little bit of a red flag. and it'd be disqualifying if I wasn't able to understand the business or the strategy. So let's see if I can make any heads or tails of what this is. Um, so the AMLP ETF, the Alarian MLP ETF, that's Master Limited Partnership. And so what this is why consider energy infrastructure now? AMPL provides exposure to energy infrastructure companies via a portfolio of MLPs. And so energy infrastructure, okay? I think that makes sense. Um, so what this does is essentially this is several companies that are in energy infrastructure, and it said somewhere along the way here that this tracks midstream energy infrastructure. So my understanding of that is that it takes oil um, from the place it's taken out of the ground and then takes it to a refining area before it ultimately ends up at a retailer or a supply depot. So you can see, yeah, 33% of the fund is in pipeline transportation, petroleum, and the plurality of the fund is also in natural gas pipeline. So we can see all that. And so um, this is kind of where I'm at. It has an expense ratio of 0.85%. That's way too high. So this is about, transferring natural gas and petroleum from point A to point B. I guess let's look a little bit further. What is an MLP? So a master limited partnership is a company organizes a publicly traded partnership. MLPs combine a private partnership's tax advantages with the stock's liquidity. MLPs have two types of partners: general partners who manage the MLP and oversee it, as well as limited partners who are invested in MLP. Investors receive tax sheltered distributions from the MLP. On the surface, that sounds attractive. MLPs are considered low risk, long term investments, providing a slow but steady income stream. That actually brings up sort of a red flag to me. So let's go back here and see what the dividend yield is on this ETF. So see if I can find like a 30-day SEC yield. So I think the question is, how does this election go? Someone's promising to drill, baby, drill. Geopolitical stuff. It's of national security interest for the United States to be energy independent. We had a hard time with supply chains during COVID, and so it seems like most of these companies probably are in the United States or Canada. Maybe I could figure that out, maybe not. But, it makes sense why it started going up, at the bottom of COVID, I suppose. Um, although the prices of gas were going down, so I don't fully get this one. It looks like it has a high yield of about 7.5%. So what I'll say about this is, I don't understand it. I don't like that. I don't like that it's done nothing but destroy shareholder value over 15 years. I can see why people are drawn to this. The expense ratio is too high, and you're kind of betting on some political and geopolitical and macroeconomic factors to be successful in this venture. And so, while it could be a good investment with a high dividend yield and a pretty bullish looking chart over the last couple of years, this is just going to be in my too hard bucket. Besides that, the expense ratio is too high. So, thanks for submitting that security for review, friend. So now I'm going to get over to Medtronics, our next subscriber review. Also, if you like the video, subscribe to the channel. This is a medical device company. I love healthcare as a sector, as opposed to like pharmaceuticals and biotech. The better sectors, I think, subsectors are going to be medical devices as well as like health insurance, for numerous different reasons. But you can see strong price performance over all time on Medtronic's $86 stock. And I could see definitely why this would grab someone's attention. Down 3% in the last 5 years. and down 36% from all-time highs. This chart actually really grabs my attention. Let's get over here to Qualtrum, a software service I pay for, but not one I'm affiliated with, but a really cool tool to look at stocks. I'm going to leave the link for Qualtrum in the description below. But let's start here and let's just look over some facts and figures on Medtronic. So this is going to be a US company, I'm pretty sure. Large cap, 112 billion. Historically low forward PE of 15.6. That looks really good. A really nice free cash flow yield of 3.22%. It looks like they have a high dividend, which is bordering on unsafe territory. That could account for some of the price action. And we're going to leave it there for the high level overviews. Let's dive into this sort of line by line. Like the video, subscribe to the channel. Taking a look at Medtronic, we're going to do our check marks, our green check marks, and our red X's. We're going to do it together in our minds in an imaginary fashion because I'm not editing this. So on Medtronic, revenue is up 6.5% over the last 10 years, but it's flat over the last 5 years and down over the last year. And so, paints a picture of sort of a mature company, I suppose. Um, I think moving forward, moving forward, maybe we can look for like 3% growth over the next 5 or so years. That's just where I'm going to go for a rough guesstimate. But we're going to do a DCF on this guy. So revenue's up into the right. I'll give it a check mark. Free cash flow up into the right. For the most part, but it's kind of bottomed out, sort of in a range here. So they had $4.3 billion of free cash flow in 23, and then 4.23 versus so less. Yeah, so the cash flows are flat. This isn't a growth company necessarily, but it does have sort of steady cash flow. For the most part, it's sort of more of a mature company from just looking at the chart. I'm going to give this a neutral rating. Let's look together at earnings per share. Over the last 5 years, they're up into the right, but only 5% a year. Kind of the same as the free cash flow, a little bit more of a mature company. I'll give this a neutral rating. Cash and debt on Medtronic. So from this point, their debt is lower, but their cash is also proportionally lower. 8 billion in cash, 25 billion in debt. It's kind of a lot. We're not seeing that delta close with debt going lower and cash going higher. It's proportionally moving in the same direction, but it's a little bit much for me. I'm gonna just give this a neutral rating. I might feel better if they have better returns on capital. Let's just see. Let's take a look at dividends. Looks like they cut one time, but it was like 24 years ago. So they're up into the right. Growing really fast, 9.4%. But their payout ratio is really high. So a 3.3% market beating yield, but at 90% of their 89% of their free cash flow. The dividend's not safe, but it is high and they've never cut it. I'm going to give it a neutral rating. I think if they were to cut it, I don't think, I think they could cut it 40% and still be a market leading dividend. So sort of a lot of neutral feelings. They've increased shares in the last 10 years and then they've been buying them back. For a company like this, I have to give that a neutral rating. Returns on capital employed are under 10%. I'm actually give that a red X. Expenses are going up into the right, also another red X. Valuation on the last 10 years, historic PE valuation is in the middle range. I'll give that a neutral rating. Really cool sounding name. I don't know a huge amount about the company, but looks pretty stable. But this forward PE 15.5 seems fair, if not a little bit high. So let's try and do a DCF on this together. Four, 2, 3, 0 plus 5, 6, 2, 0 plus 4, 5, 4, 0 plus 5, 7, 2, 0 plus 5, 5, 8, 0 equals divided by 5, average free cash flow. Average free cash flow is closer to this number, $5.1 billion. 5138. Medtronics, behind the scenes, not financial advice. Rough discounted cash flow, fair value estimate, valuation here. Like the video, subscribe to the channel. Most recent 7730 for cash. At 2374. 23740. 23.8 billion. 23740. 23740. Okay. And then shares outstanding. 1.330. 86 stock. Worth $45. I think the stock's overvalued. Another reason that I think that is these growth rates are optimistic. So I'm not going to lower the discount rate because I think the growth rates are optimistic. So I think Medtronic is overvalued. I would not buy it. I would not own it. Thank you so much for submitting that stock request, my friend. Okay, like the video, subscribe to the channel. We're on to the next. We're going to be looking at another investment here. Subscriber request, IMPP, Imperial Petroleum. Right off the bat, it's a penny stock trading for under $5. I typically don't buy penny stocks. I hate the way that this chart looks, down 90% all time. Let's see if I can learn something about this company annually. Let's figure out what they do first. Imperial Petroleum provides international seaborne transportation services to oil producers. So it's kind of like this other ETF, the shipment of energy or gases, but instead of in a pipeline across a continent, this is across oceans. I could see why this is definitely, on the front of someone's mind with everything going on in the world. One thing that I don't like, it's been publicly traded for 4 years, so I don't have 5 years of data. Huge jump in revenue, which might make someone think that they've had a huge jump in revenue, so maybe their share price should go up, conceivably. Share repurchasing. Just went up for no reason. So from its bottom point, it's around 182%, but it's down 90% all time. This looks kind of like a trap. It looks a lot like the things on the other deal. A lot of things have to go right for this, and you're banking on political, geopolitical, macroeconomic type things, which I don't like. So it's not enough data because it's only 4 years. This is a huge boost in revenue. You'd want to understand what was going on with that. Why did their revenue go up and then their free cash flow went down? That doesn't make a lot of sense. I hate it. Maybe they're investing into themselves or something. They have a 32% dividend yield. That's a trap. Never buy something that has a 32% dividend yield. If you buy something that has more than about a 7-8% dividend yield, in my experience, pretty much every time I've seen those dividends get cut. So really bad returns on invested capital. They just issued a bunch of shares. Um, I strongly do not prefer this. At this point, I would stop looking into it. I would have stopped earlier, really based on its value destruction of 90% being a penny stock. I could see the appeal, but I do not like this. Thank you so much for submitting this stock for my review. I appreciate it very much. Okay, so now we're going to get on to our last stock. A subscriber had asked me to review. This is called Matson. Matson is an American shipping and navigation service. Oh, more of the same. In Honolulu, Hawaii, founded in 1882. It provides ocean shipping services across the Pacific to Hawaii, Alaska, Guam, Micronesia, South Pacific, China, and Japan. Very interesting. Looking at this company, Matson, up a lot over all time. They've been publicly traded. It's about a 200-year-old company, been publicly traded for a long, long time, since 1984. Last 5 years, that's a super bullish looking chart. I could see why that would capture someone's interest. $116 stock. Let's get over here to Qualtrum. This is going to be like a small to mid cap stock. So you could have some irregularities in the pricing. Not as many people are looking at this, so it may be mispriced. Forward dividend yield or forward PE ratio, rather of 17.6. Doesn't seem weird. This looks pretty attractive, 6.43%. Obviously, this company could have one of their ships captured by pirates, and you could have your stock collapse by 20%. So people aren't wanting to pay a lot for this free cash flow, but the cash flow is there. It's looking good. If you're still with me, like the video, subscribe to the channel. If there's a stock you'd like for me to look at, leave it in the ticker symbol in the description below. Payout ratio, they pay a dividend. It's only a 1% dividend, but a super low payout ratio, so there should be some good dividend growth on this company. Let's blaze through this. Revenue, last 10 years, 10.25%. This has something to do probably with COVID, Ukraine, tensions with China. So there's definitely a lot of these same risk factors I was talking about, assumptions that have to come true probably for this company to do well. Up 10.25% over the last 10 years. Revenue's up into the right. Give it a check mark. Free cash flow. It's a little bit cyclical, but it looks pretty dang healthy. This looks like a change in the trend. Let me actually just get this number now. I'm going to do a DCF on this one. This is the one that's most attractive to me. So you win nothing, but thanks for submitting it. Yeah, check mark on this free cash flow. Six, 3, 9, 5, whatever. 2, 1, 8 equals divided by 3. something like 632 million of free cash flow. It doesn't take into account these years. I don't have time to mess around with this. I'm just going to give this a higher discount rate because this is the free cash flow is cyclical, the revenue's cyclical. It's a smaller cap stock. That's just how I'm going to sort of get a rough idea. It'll get us close to where we want to be. Like the video, subscribe to the channel. Earnings per share up massively. Check mark. Cash and debt actually looks good. Debt's going down, cash is going up. That's fantastic. Big check mark. Dividends have never been cut. They've always been risen. A lot of dividend growth ahead of this company. Big check mark. Shares outstanding. They've always gone down pretty nicely. Not too much, not too little. Goldilocks, check mark. Returns on capital employed. Even at their low point, wasn't horrible, like 8%, but recently just massive returns on capital. That looks good. Check mark for returns on capital employed, but it is sort of variable. Valuations, historical valuations, 10 years. Trading low on a PE basis, that's a big check mark. This one's interesting. Expenses are going down, check mark on that. All the insiders are selling shares around $95. You'd have a purchase around 65. Okay. Matson Inc. Very interesting. And all right, folks. Recorder just timed out, so I decided to go back for Matson and do everything properly. I looked for maritime shipping projected compound annual growth rate. Seems like 4% over the next 10 years is pretty good, and that's quite a bit lower than the numbers the company Matson has been putting up. I went ahead and averaged the 3 positive years of free cash flow with the 2 slightly negative years and came up with a good estimate, or a good average rather, on the free cash flow. And so this stock, Matson, is trading for $116 because it is sort of a smaller cap stock that's dependent on different macroeconomic geopolitical things, and because of its size and its risk factors requires more of a return to compensate for risk. Putting all these facts and figures and projections in from Qualtrum and my opinion as well, I come up with a fair value of $115 with a 12.5% required rate of return. So this one's trading near fair value, and it's very interesting. And so what we won't have time for today, but where I would leave this type of perspective of investment is I'd go and see who are all the competitors to Matson. What type of forward PE ratio do they trade for? What type of free cash flow yield do they trade for? And I'd also watch some interviews with the CEO of Matson. And it's one of the secret ingredients in my stock screening recipe I've never before disclosed, but it's called the idiot test. So if all of this is great, but the CEO is slack jawed mouth breather, that can lead me to not invest in something that otherwise looks great. Quote of the day, Warren Buffett: invest in a business that even an idiot could run, because one day he will. All right, so that's it. Thanks a lot for tuning in and watching this video to the end. As always, if there's a stock or an ETF you'd like for me to review, just drop its ticker symbol in the comments below. I usually like to collect a few of them so I can put out just one raw video. So might take me a little while to get around to it, but I certainly appreciate you stopping by, watching the video, supporting my channel. This is Sean, and I will see you on the next one.